Welcome to tonight's webinar, Prelude to a Post-Pandemic Pop, presented by Sam Stovall, Chief Investment Strategist of CFRA Research. A handout of the presentation is available under the Handouts panel of your GoToWebinar control panel, located on the right-hand side of your screen, as well as instructions on how to operate the control panel on your device. If you have questions for our presenter, please submit them using the questions panel of your GoToWebinar control panel. Our moderators tonight will select questions submitted and read them aloud for the benefit of all watching the broadcast. If you experience any issues with the audio or video of tonight's webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support, which you can find at www.gotowebinar.com. A replay of tonight's presentation will be available tomorrow on AAII's YouTube channel, along with links to tonight's handout and to some of the resources discussed, and will be sent to your email address. Now, please sit back, relax, and enjoy tonight's live presentation.
Hello and welcome. My name is John Bajkowski. I'm really excited to bring everybody together in our online community here. And our goal with these webinars is to really bring you, connect you with the top leaders in the world of investments to give you some education and guidance on how to navigate these suddenly stormy waters. So thank you, Ryan, for introducing us and also being the producer tonight. So if you have any questions, Ryan will be taking those in the background as far as technical issues are concerned. Ryan is our head of community efforts here at the association. So Ryan heads up our local chapter network, our investor conference, and our newly launched online events such as these webinars. So please, any kind of technical questions, Ryan will do his best to answer those for you or direct you to resources as far as that is concerned. Joining me tonight also from the association is Charles Rotblood, and Charles is the editor of the journal, and the two of us will be acting as moderators, and we'll be doing our best effort as far as bringing your questions over to Sam as he through the course of the night, so that we can customize the webinar as much as possible to get your answers to your questions. I'm really kind of excited here to have a special guest tonight, Sam Stovall. Welcome, Sam.
Happy to be here.
Thank you. You're the Chief Investment Strategist of CFA Research and Chairman of the CFA Investment Policy Committee. And I guess you're really kind of known as a historian and kind of a sector strategist. And I think one of what I've always liked about your work is that you've been able to take really market history and make it available as really actionable items. And how can our members, how can investors normally see your work?
Well, certainly they can see it by being a subscriber to the Outlook, which is a publication that's been around since the early 1920s. They can become a subscriber to our MarketScope Advisor platform by simply going to CFRAResearch.com and learning about the offerings that we have. Every so often, Charles Rotblood will reach out to me and say, Sam, I saw an article that you wrote that I really liked. Would it be okay if I republished it in the journal? And of course, being involved with the AAII since the mid-1980s, I was the program chair for the New York chapter for 8 years. I'm always happy to help out the AAII. The only question I have is it AAII or AAI?
I've also heard A squared, I squared, so I really can't help you too much on that effort. It's quite a mouthful no matter what you say. Exactly. I'm surprised you're being kind of modest though. You didn't even mention your book here that I actually enjoyed quite a bit.
Well, thank you. Well, what's interesting is that a lot of times questions are generated and people might not have the answers. So I figure, let me do the research and I'll come up with my own answers. And this first happened back in the mid 1990s, or actually the early 1990s, 1994 to be specific. The Fed started raising interest rates, which they did 7 times in a 13-month period. And I tried to figure out, well, which sectors, sub-industries, the best or be hit the hardest during a rising interest rate. Really couldn't find any answers to those questions. So what I did was I went back to World War II, looked at the sub-industry information, put them together with economic cycles, and wrote the first of my 3 books that nobody bought called the S&P Guide to Sector Rotation. And basically you can find it on Amazon or eBay today. What I did was I looked through the economic cycles since World War II, showing in general, when did sectors have their day in the sun? When did the sub-industries do the best and do the worst within an economic cycle? But then later I realized that trying to figure out where we are in the economic cycle and then saying which sectors should do well or poorly is putting the cart before the horse, because the stock market tends to anticipate the economy by an average of about 7 to 8 months. So in the most recent book that I wrote that you just held up, the 7 Rules of Wall Street, these are old rules of thumb that still work today. Adages such as let your winners ride, but cut your losers short. I did analysis going back to 1990, looking at sectors and sub-industries to say, could these rules still work today if you wanted to embrace a rules-based investment approach? And of course, the answer was yes.
Wonderful. If actually, I had a copy of 7 Rules of Wall Street at the office, but here we are sequestered at home. I was able to go on Amazon and actually pick up a copy. So it might be out of print, but it's still available through a number of resellers through Amazon. So it's a wonderful read, and it really condenses a lot of wonderful information in a easy to use format. The other thing I think is important to mention, I know CFRA Research is really an independent source of information. I know if you're most brokerage firms, when I do research and I pull up some information on a company, often you can quite easily get a CFRA research report on a company. So I really do enjoy the work you guys do, and the outlook. I mean, we still keep binders of them in the office. They're a wonderful reference. I know you do the commentary in that, I think, every week, if I'm not mistaken.
That's correct. The Outlook, as I mentioned, has been around since the early 1920s. Actually, we all came from Standard & Poor's. Back in the third quarter of 2016, S&P decided to get out of the business that had started back in 1860. There really was a guy named Henry Varnum Poor who wrote research reports on railroads, and S&P therefore had its stock market research, the old tear sheets that had been around since then. But then I guess they concluded they wanted to focus on their data, the debt ratings, as well as the indexes. So they sold our equity research department to a company called CFRA, which stands for the Center for Financial Research and Analysis, a truly independent research firm that, based on the most recent Investars report, ranked us as #1.
Wonderful. Well, I don't want to keep the people from hearing your presentation. Why don't you go ahead and take over, and as questions come up, please ask them in the area, and we do our best to get them to you.
Wonderful. Well, all right, what I'm going to do then is take us off screen so that people can then look at something a little more interesting. I will share my screen if I am clicking the buttons correctly. Or change presenter, is that me? Help. All right, what am I doing wrong? Can you, there we go, show my screen. Yes. Are you seeing my screen?
Yes.
Yes, we are now.
All right, boy, and to think that I was an audio visual, had a Bell and Howell button from 7th grade. So here we go. I'm gonna turn this into the presentation mode if I can. Well, I'm not gonna worry about it. So we're looking at Prelude to a Post-Pandemic Pop question arc, because the real question is, are we getting ready to pop right now, or do we still have a lot of work to do going forward? Obviously, we have just gone through, as John had mentioned, a very challenging time in the marketplace. We have headwinds that we still have to contend with. What is the total magnitude expected for this COVID-19? That is still something uncertain. We had skyrocketing unemployment at the most recent report. 4.4% was the most recent report. Our economists think that the April data coming out in early May will actually be the most challenging, with 15 million people out of work, with the non-farm payrolls falling by 15 million in the May report. Also, we're looking at The question of, are we dealing with a recession or are we dealing with a depression? That's a question that will come to fruition fairly soon. Also, we're going to be questioning whether are we dealing with decelerating earnings and economic growth. John, I keep getting these screens popping up saying no more attendees allowed. Is this being seen by everybody else? Because
Yes. Sam, if you could please just hit don't show again and then click OK.
Okay. My apologies, everybody.
Sorry about that.
That's all right. I was trying to talk around it, but I wasn't doing a good job. Don't show this one either. Get out of here. Okay, let me start again. Good evening. No, I'm kidding. So decelerating earnings growth, PE contraction, and we also had a pretty bad indicator at the end of March. The market was down in January, it was down in February, and again, it was down in March. I will show you a chart that indicates that historically, that's not a very good thing. However, this bear market and the response to the COVID-19 problem has been unique in terms of speed and also in terms of magnitude by the Fed as well as by the US Congress. So that could end up offering a bit of a tailwind. We've also beginning to hear some relaxed regulations, specifically in the financial community, and maybe we end up getting some reinstating of some trading restrictions. I still wonder why there is no uptick rule any longer for shorting. We did have some very attractive market and individual stock valuations, so those did serve at least temporarily as tailwinds. So let's go a little bit deeper into what went on. If we go back to February of this year, what I say is that this was a correction in search of a catalyst. The PE ratio on the S&P 500 was at 19.6 times forward 12-month earnings. The last time we were this high was in spring of 2002. We were also looking at the percentage of sub-industries in the S&P 500 that were above their 200-day moving average. This was more than one standard deviation from the mean, again, a level of excess that basically was implying complacency and making investors vulnerable to some sort of a market shock, and we certainly got it. Then the question was, well, why did so many strategists, myself included, think that this would not end up being that big of a deal? You know me, that I like to say that history is a great guide, but obviously it's never gospel. Mark Twain once said, history might not repeat, but it frequently rhymes. I also like to add, but like the singer of the national anthem, sometimes it forgets the words. So when we look back to 2003, we looked at SARS, swine flu, MERS, Ebola, Zika. We saw that 30 days after the first US reported case, 60 days after, and 90 days after, in every one but one observation, the market was higher. Even after 30 days with COVID-19, the first reported case was January 21st of this year, the market was up by 1.6%. Yet 60 days out, in that second 30-day period, the market exhibited the glide path of a crowbar and fell almost 32%. So I think basically what happened was you had a lot of people who didn't really understand how this could, like the Spanish flu of 1918 through 1920, would end up enveloping the entire world. I think this is one reason why people felt that it might not end up being as wide of a problem as it ended up being because of what history had told us. So we then see, okay, the market peak on February 19th. We ended up falling into a bear market, meaning a decline of 20% in only 22 calendar days. That was twice as fast as the second fastest 20% decline, which was in 1987. What we saw in terms of sector performances, everybody declined. A lot of people say, but Sam, why didn't the defensives do well? Well, they do well on a relative basis. that basically whether you're dealing with sectors, styles, sizes, even asset class such as real estate and commodities, they tend to fall in a bear market that is triggered by concerns about the global economy. They're called defensive because they simply lose less than the overall market. I jokingly say that, well, when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. And that's why consumer staples and healthcare do so relatively well versus the market as a whole. Communication services, well, I guess misery loves company. You got to call somebody to complain about what's going on. And so also in here, media is what's found. So if you're in a recession, you don't really have time to the money to go out and so forth, you stay at home and you use your cable TV, et cetera, and hence communication services tends to do relatively well. Not surprisingly, financials, industrials, materials tend to be underperformers. Utilities, however, are usually above the blue line, mainly because the demand for the products and services remains fairly static. However, this time around, utilities and real estate in particular took it on the chin because prior to this meltdown, investors were looking to these income-oriented groups as bond substitutes. They were looking to utilities, which averaged a dividend yield of a little more than 3%, looking to real estate, which offered a dividend yield of 3.5% to 4%, and used them as surrogates for the much lower yielding treasuries and corporate bonds. So when the market did go into a tailspin, it ended up dragging these down much more than they normally would have. So the two tables on this chart, the left-hand side shows what happened in this bear market. The right-hand side shows what on average has happened going back to World War II. I took these sub-industries within the S&P, brought them up to the sector level because the S&P only had sector level data starting in 1990. I then showed the batting average, the frequency with which this sector beat the market during these bear market periods, and that's the outperformance number. So healthcare and staples beat the market 85% of the time, real estate 71, utilities 77, materials 46, etc. So that's basically what this chart shows, is what happened this time and how it wasn't too different from what usually happens in bear markets. Now the question that I frequently get is, okay, Sam, how low can this bear market go? Now, obviously, I was getting that prior to March 23rd. And again, nobody knew for sure because COVID-19, not only being a novel virus, was a novel bear market kind of scenario. Nobody really knew for sure how far down it would go, what kind of an impact it would have on the economy, what kind of an effect it would have on corporate profits, and what would happen to investor sentiment and what it would do, therefore, to the PE multiples. So I went back to World War II and I looked at all recessions. So on the left-hand side, you see peak, trough, months showing how long the recession lasted. I showed GDP percent, which is what was the percent change in nominal GDP over this 8-month, 10-month, 11-month period to see what kind of a magnitude of decline we saw in those recessions. Then I show the S&P 500. So in terms of earnings per share, the closest quarter to start, the closest quarter to end, what happened to earnings over that time frame, what happened to the price, and then what happened to the PE ratio. Interesting, as you can see, the price really only fell half of the time. Reason is, if you look toward the right-hand side, you see corresponding corrections or bear markets, peak, trough, the months, and then the percent change. And then on the far right-hand side, we see months before. What that means is that when did this stock market start to fall into its decline? And on average, the market anticipated a recession by 7.7 months, or essentially 8 months. The market did fall into what I call a garden variety bear market of 27% decline. and that basically the decline lasted almost 14 months. So trying to figure out, okay, the duration, the magnitude, but then also looking at earnings and the PE ratio going back to those two yellow columns, what I found was that on average, the earnings declined by a little more than 10% during recessions, and the PE multiple shrank to about 12 times. So then the question is, okay, well, what would happen to us this time if the S&P 500 saw a 10% decline in earnings and we had a down to a multiple of 12 times? Shows three things. First, the first grouping is the 2020 earnings estimates. The middle grouping is what is the percent change from the February 19th high, and then what was the percent change from the S&P 500 as of March 31st of this year. So we see in the left-hand grouping $163.94 as one of the column heads. Well, that's what the earnings were for 2019. So if we had no earnings growth in 2020, it would be 163.94. If we had a 5% decline in earnings, it would be 155.75. If we had a 10% decline in earnings, it would be 147.55. Well, we pretty much started with a PE well above 16, which is the average going back 20 years. But I blocked out a multiple of 12 times with that 10% decline in earnings and came up with 1771. So a worst case scenario, if you will, would say that, you know, we could see this bear market emulate the bear of 2002 that fell about 48% in total from peak to trough if we saw earnings go down by 10% and we saw the multiple on the S&P 500 drop to the 12 that it averaged going back to World War II. Obviously, we have not seen that at this point in time. Yes, we are looking for a more than 10% decline in earnings now for 2020, but the market still seems encouraged and is trading, oddly enough, on a forward 12-month basis of more than 20 times and on a trailing basis that is well in excess of where we normally trade during recessions. I also wanted to find out, well, we had a very long, a very large, and a very expensive bull market just prior to the bear market that we fell into. Can history offer a bit of a guide based on the duration of the bull market? Whoever is typing, please put yourself on mute because then we won't have to compete with each other. So looking at bull markets based on the duration, looking at prior bull markets based on the average percent gain, and what was the PE ratio at the top of that bull market. Obviously, since this one arguably was the longest since World War II, it had the second greatest percent change and also was the second most expensive. In all three cases, it was to the right, meaning long, large, expensive, because it was to the right of the median of all bull markets since World War II. Average price decline during bear markets, whenever they were short, small, or cheap, was what I call a garden variety bear market, less than 30%. But those that were very long in duration, very high in terms of overall price gain and expensiveness at the top of the bull market, leads us to believe that, you know, this could have been what's called a mega meltdown bear market, or a bear market of 40% or more. So again, this is just using history as a guide because in many ways we didn't have much more than history to serve as a guide. And then if you recall, I mentioned, gee, what happens to the stock market whenever the market itself was down in January, down in February, down in March? What happens for the full year? Well, the bad news is this is the 7th time since World War II that all 3 of the first months were negative. And in 6 of those 5 of the 6 prior times, the market fell for the full year. And in all 6 times, the average performance was minus 14.8. In terms of the remainder of the year, meaning from March 31st to December 31st, the average price change was a decline of 8.5%. The good news is that in the subsequent year, the market was up 5 of 6 times with a gain of close to 15% and being up 5 of 6 times. Now, if we have any mathematicians in the audience, any statisticians, they're probably laughing right now, because when you look at this chart and you say, Sam, 6 observations are not statistically significant. But still, this is the kind of data that when you go on to financial TV, they're trying to stir up your emotions so that you will tune in tomorrow to see if the world did come to an end. You know, they want. Okay, I am unmuted. Good. So now the question is, what about, that's enough of history. Everybody now just got their associate's degree in bear market history. Let's talk about what could be driving the possibility of a deeper decline. There used to be the old saying that bull markets don't die of old age, they die of fright. And what they are most afraid of is recession. Well, looks like we're going to get a recession, and the World Trade Organization basically just told us that they think that we could be seeing something that rivals what was seen in the Great Depression. This is data updated actually just before we went on air. This is Action Economics data of forecasting global, regional, and US GDP for 2020. So global GDP as of January 14th, meaning just before the first US case of COVID-19, global GDP was expected to be up 3.3%. The US was expected to be higher by 2.3%. China was expected to have some challenges, but be up 5.7%. Yet through today, what we found is that global GDP is barely going to keep its head above water, up 0.7%. Advanced economies are likely to fall by 2.3%. The US will fall by 2.8%. Europe down 3.2%, Japan off 1%, and now China basically being less than half of what it was in 2019. And I think that based on Action Economic forecasts versus other economists' forecasts, they're actually being a bit conservative, being less sensational than many other economists on the street today. If we divvy this up a little bit and look at quarterly expectations, well, what we find is that these numbers are also tumbling. First quarter initially was expected to be up 1.9% in real GDP. Now the forecast is for a 4.5% decline. That's because we got horrible retail sales numbers today, down more than 8%. We got very soft Empire survey data. We had industrial production come in much weaker than expected. Tomorrow we're likely to see very weak housing starts and building permit data. So it looks as if it's not something that's going to be concentrated in the second quarter, but actually a lot of weakness is expected to have arrived in the first quarter. The 2.6%, the blue bar, was the expectations as of January 14th for the second quarter. Now the forecast is for a minus 25%. Yet as you can see, our economists are anticipating a V-shaped recovery, that once we go back into the marketplace, into the economy itself, we are likely to see a 20% surge in real GDP in the third quarter, a 10% rise in the fourth quarter, and then see a full annual advance in 2021 of more than 5%. So from an economic perspective, it really seems as if our economists are saying it's going to be a bad first half, but the second half will end up making up for a lot of this decline. But then the question comes down to, okay, well, if that's what the economists are saying, what are the analysts saying about US earnings, about foreign earnings? And let's break them up into developed and emerging markets. Well, Wall Street tends to look beyond the valley, as I like to say. And unfortunately, this valley continues to get longer and deeper. So if we look to the blue bar, well, that's what we earned in 2019. So S&P 500 earnings were up 1.3% in 2019. Today, the estimate is for a minus 13% for all of 2020. But then the expectations are for a near 22% jump in 2021. The developed international, so this is the S&P's version of the MSCI EFA, if you will. These are the middle bars. Earnings were down 3.2% last year, expected to be off almost 18% this year, but then jump by more than 28% next year. And the far right-hand grouping are the emerging markets. Earnings off more than 11% last year, should be down about 3% this year, but then up 21% next year. So on a 10,000 foot level, yes, it does appear as if 2020 is going to take it on the chin. But I guess it's like a fan of a perennial cellar dweller on opening day lifting up a sign that says, wait till next year. I think that's what investors are doing, is they're saying, we're not even reporting first quarter earnings 2020, but let's not even worry about 2020. Let's focus on 2021. So I think that's what investors are attempting to do in order to maintain their optimism. However, as this very busy chart shows, they're having a hard time maintaining their optimism. This chart on the left-hand side shows you the S&P 500 sectors: communication services, consumer discretionary, etc., all the way down to utilities, as well as the S&P large cap 500, mid cap 400, small cap 600. The white columns show what was the earnings percent change as of March 31st, meaning at the end of the quarter, less than half a month ago. What was Wall Street analysts expecting? So communication services were expected to be down 1.3%. But just the other day, estimates showed a 4.9% decline. So the first grouping is for the first quarter, and then the second grouping is estimates for the second quarter, third quarter, fourth quarter, and then the full calendar year. And every single sector, quarter, and year estimate has come down. In the first quarter, looking at the S&P 500, as of the end of March, expectations were for a 5% decline. Now we're looking at a 12% decline. Well, what about full year? Go to the far right-hand side. As of March 31st, the full year was also expected to be off 5.1%, but now the expectation is for a 13% decline. So obviously, investors are very concerned by what they're hearing and are not really sure what to make of all of this. So they just simply are looking to reduce their earnings estimates. But isn't it interesting? This slide shows that from the market bottom on March 23rd through Monday, April 13th, basically we're looking at a counter trend rally. Every single sector, style, and size was up by double digits. S&P 500 up 25%. 100% of the 128 sub-industries in the S&P 500 were in positive territory, and all but a handful were in double-digit advance mode. So basically, we had a very strong rally off of this retreat. And so investors were feeling pretty optimistic that, okay, we pretty much priced in a very bad scenario in terms of GDP. We've also set the bar exceptionally low in terms of earnings. And I think that investors were basically saying, look, how can I hurt myself falling out of a basement window if the earnings are set so low to begin with? As a result, the only surprise I will likely experience is a positive surprise. So I think that could be what has caused investors to gravitate towards stocks. But it could be that we are going through your traditional retreat, rally, and then waiting for the retest. So what could happen in terms of a retest? Well, we see here the S&P 500 up almost 25%. That is not unprecedented. That is not unheard of. Actually, back in the bear market of 2007 through 09, the S&P 500 was down 52% through November 20th of 2008. We then rallied by 25% heading into the first week of January of 2009, only to turn around again and then to fall and set an even lower low on March 9th with the S&P down 57%. So could that happen this time? Possibly. We could simply be in the rally mode that will require some sort of a retest. Will it end up going lower than the March 23rd low? I don't think so. And it's because of and here I'm going to use that word again that everybody is very tired of, unprecedented stimulus that's being injected by the central banks around the globe, as well as here in the US, as well as the government actually agreeing at least once and looking to add some more stimulus down the road. So this is a very much an incomplete list of the things that the Fed reducing interest rates by 150 basis points in March, correcting the money market mutual fund liquidity facility, buying up bonds that include munis, the European Central Bank, Bank of England, the Switzerland National Bank also getting involved, US making withdrawals from 401ks and IRAs penalty free, but you still have to pay the capital gains. Congress passed its $2 trillion stimulus package. And we have more, so this table could easily be updated. But I think it's because of the speed with which the government and central banks have responded, and also by the magnitude. And I just heard today that two representatives have sponsored a bill that will pay Americans $2,000 per month until the unemployment rate gets back to the pre-COVID level. Well, that was 3.5%. So we might be getting checks for $2,000 for quite a long time. This chart shows just how depressed sector valuations got as of the low on March of this year. The first grouping are absolute PE ratios. So here we have the 11 sectors in the S&P 500, the 500 itself, and its growth and value components. What was the current PE as of March 23rd? Well, we got down to 14.2 on a forward 12-month or next 12-month earnings basis. The average PE over the last 20 years has been 16.4 for the S&P 500. So it was trading at a 14% discount to its absolute average PE over the last 20 years. And we can see financials, healthcare, industrials, tech, materials, real estate, trading at double-digit discounts, all but one being more than 20%. Energy had been trading at a substantial discount, but because oil prices fell out of bed, so did earnings expectations along with prices. So as a result, because prices have fallen as quickly as valuations, that they're basically not showing a premium or a discount at this point. On the right-hand side, we say, okay, well, what is the current relative PE? So the PE of this sector divided by the PE of the S&P 500. What has been the average relative PE going back over the last 20 years? And again, we see that financials, healthcare, industrials are trading at double-digit discounts. One reason why the utilities did so poorly is because they're still trading at a 10% premium, even with their big sell-off. Energy trading right now at a premium of 18 times its relative. And then consumer discretionary also getting hit hard because of the restaurants, the casinos, the cruise ships, and so forth that are found within this sector. getting hit quite hard. On the bottom level, we see the S&P 500 growth and value. The value index was trading at a 20% discount to its absolute PE and about a 14 discount to its relative PE. So as of March 23rd, we had very attractive valuations, certainly not as attractive as they were back in March of 09, but still relatively attractive. And here I'm showing you the rolling percentage of the 148 sub-industries in the S&P 1500 that consists of the 500 plus 400 plus 600 indices, in a sense S&P's total US stock market. And you had more than one standard deviation trading above their 200-day moving averages, and only in a couple of weeks did we end up seeing that number go down to 0. So a level that had actually been lower than what we saw on the Friday before the March 9th bottom back in 2009. People frequently will ask me, well, Sam, when will this end? What indicator do you have that you are looking at that will help you to figure out that maybe the worst is behind us? Well, if fundamentals tend to be lagging indicators, meaning that we have the economic growth expectations lagging based on data that comes out, if we end up having earnings that tend to be revised lower based on, in many ways, on the stock market itself declining, that's why we have the old adage that prices anticipate or lead fundamentals. So what I did was I simply downloaded data from Yahoo, meaning I got the high for the day, the low for the day, and every day what I simply did was compute what was the percent difference between the high and the low. And then I plotted out a rolling 15-day average. So this chart, this jagged chart that looks like an EKG diagram, I probably should have had it in red to emphasize it, but this is simply a rolling 15-day average for the intraday percent change. And you can see we have several stalagmites, 11.3 of 87, 9.17 of 98, 8.7 of 02, etc. That once we go to a peak and then actually start coming down, we don't then go back up. It usually indicates that from a capitulation perspective, the worst is behind us. If you were to flip this on its head, you could say, you know what, it's like dropping a ping pong ball on the table. The first bounce tends to be the greatest, and then the other ones tend to be a bit more muted. So here, March 27th was when we saw this rolling 15-day intraday percent change peak and roll over. And so on the right-hand side, it's almost like a magnified view of what it looks like today. We are definitely coming down back toward the 2 standard deviation level, going back at least since December of 1986. So usually within 1 month, we find that the bottom is put in place. You might say, well, that's not the case back in 2008. You have October 28th of 08. But interestingly enough, November 20th did end up being the bottom for many stocks within the S&P 500. Go back and take a look at their charts and you'll find that the bottom was on November 20th and that March 9th ended up being a successful retest for those individual stocks. So I still believe that this can be a pretty good indicator that the worst is behind us. Now, what if I'm wrong? What if I find that the stock market does end up going a little bit deeper? You know, the question always is, okay, well, we've had declines, 5% plus. We've had more than 80 of them. Since World War II, I've counted that we have had 58 declines of 5 to 10%. On average, we've lost 7%. It took us only 1 month to go from peak to trough. And then most important, it took us 2 months to get back to break even. We've had 23 corrections or 10 to 20% declines. Most important is it only took us 4 months on average to get back to break even. We've had 12, this is now the 13th bear market, but we just don't know if it's going to be a garden variety or a mega meltdown. If this is a garden variety bear market, it might only take 14 months to get back to break even. So I guess what I say based on this information is if you don't have 14 months, you probably should not be invested in equities. So now what do? Do I have any kind of investment recommendations? My first thought is to say yes. In New York, what we say is from worst to foist, or in this case, from worst to first. That I have found that whether you're looking at the sectors within the S&P or the sub-industries, if you owned those 3 sectors starting at the market bottom, those 3 sectors that had fallen the most from the peak to the trough, that they ended up significantly outperforming the market as a whole 6 months later. Also doing the same thing for those sub-industries, those 128 sub-industries in the S&P 500. You pick the top 10, those, or the bottom 10, if you will, those that fell the furthest. You own them equally for the coming 6-month period. How did you do? Well, the bottom line pretty much tells everything. While the S&P 500 gained an average of almost 29%, 6 months after the conclusion of declines of anywhere from 19.3% up to 56.8%, while the market was up almost 29%, the sectors outperformed the market by an average of 13 percentage points, and the sub-industries outperformed the market by an average of 32.6 percentage points. So in other words, this usually ends up being a very good way of outperforming the market in the near to intermediate term. So what were the worst sectors this time around? Well, energy, financials, and industrials were by far the worst performers. Industrials off almost 42%, financials down 43%, energy down the worst at 56%. So the premise would be that you would own each one of these in equal proportion for the coming 6 months, and that these 3 as a group would end up beating the market as a whole. In terms of the sub-industries, these are the 10 sub-industries that fell the furthest during the February 19th through March 23rd low. And what I did was I showed what are the stocks that CFRA equity analysts have, what is the best recommendation that they have within that category. So like Alaska Air is a 4-star, meaning we have a buy recommendation on it. Whereas Kohl's, we have a sell recommendation on it, but that is the primary representative within that sub-industry. Hilton has a hold, as does Whirlpool, Harley Davidson, and so forth. So you can see what the recommendations are based on how poorly the sub-industries did, but then what stocks within those sub-industries we think are likely to be outperformers. This chart shows the different portfolios that CFRA has up on our MarketScope Advisor platform. These are the 3-year compound annual growth rate relative performances, meaning I simply took the 3-year CAGR for the portfolio minus the 3-year CAGR for the S&P 500. So this is the percentage outperformance. So our intrinsic value portfolio, which basically says, gee, if we wanted to follow the technique that Warren Buffett explains in his annual letter, how would we do? Well, actually, we would do pretty well, and that's how this has done. Industry momentum is my strategy, where I look to those industries like the old adage, let your winners ride, but cut your losers short, basically says you want to buy those sub-industries that are in the top 10% and then hold on to them until they fall out of the top 30%. So basically, you let your winners ride. High quality capital appreciation are those stocks that have buy and strong buy recommendations that also have an above average frequency of raising earnings and dividends, as shown in the S&P dividend earnings and dividend quality rank, which is that letter grade of A minus, A plus, to show those that are above average. Also, as John was mentioning, in the book that I wrote, The 7 Rules of Wall Street, there are a lot of rules of thumb that still work very, very well. If you are somebody who likes to second guess yourself, if you're somebody who can be indecisive, I jokingly say I'm so indecisive that my favorite color is plaid, then you might want to embrace a rules-based investment approach. One of these is the third one here, sell in May, then go away. Well, really what I tell people is you don't want to go away. You don't want to retreat. You want to rotate. You want to gravitate toward those sectors that do best in the May through October period, and then rotate into those that do best in the November through April period. And what we traditionally find is that May through October, it's the defensive sectors that do best, healthcare and consumer staples in particular. And then November through April, it's your cyclical sectors that tend to do the best. What I did was I went to S&P and I said, hey, can you compute a index for me? Create a custom index based on my seasonal rotation strategy and let me know if it works. So the blue bars show the S&P 500 equal weight index, and then the orange bars show the performance for the custom index, the seasonal rotation custom index. And you can see whether we're dealing with the most recently completed 6-month period, which was May through October. The strategy beat the market 5.4% to 2.2. It also did so in the past 12 months through the end of last year. And then you can see, as well as I, 3 years, 5 years, 10 years, 20, and since inception in 1990, this strategy has worked out very well. I'm not Bernard Madoff. It does decline, and typically it declines. But I can say that since 1990, than the market as a whole. If you want to learn more about it, take a look at the web on the bottom right of this slide at paceretfs.com. They created an ETF. The ticker is SZNE for season, SZNE, and you can learn a little bit more about it by going to paceretfs.com. And John, Ryan, Charles, I will wrap up with this slide saying that we understand how challenging it is right now. We are offering to everybody complimentary access for 90 days to our flagship publication, The Outlook. And we're giving it really to individual investors, and we're telling financial advisors that they can let their clients know as well. So if you go to the website, the second from the bottom, advisor.marketscope.com, put in that URL, what it will do is you will register, and then maybe 5 minutes later or whatever, you then get an ID and password. It will not be instantaneous, but you sign up and then it will come back and tell you how to sign on. And we want to then offer you complimentary access to the Outlook for 90 days. And then lastly, if you simply just want to learn more about CFRA Research itself, that is the URL found on the very bottom. So with that, everybody, I will stop adding hot air to the room and turn it back over to you if I can see how to do so.
Well, thank you very much, Sam. Very informative there. We've got a number of questions that have come up, and I guess one has to deal with the area of growth versus value investing. And really, we've had, growth has sort of dominated the spectrum, even almost last 10 years. How do you see that coming out of this current market downturn?
Well, what I find very interesting is that, I've learned going through all the years that, over the long haul, you want to be a value investor. Yet if I look at the S&P 500 value index and growth index, and I compute what is the price performance 6 months before a decline of 10% or more, during and 6 months after, 75% of the time or more, growth beats value. So I don't know if it's because of how the index is computed, or maybe it's because by the time something you have purchased at a very low price works its way to a high price, it has been moved out of value and into growth. But all I know is when looking at the growth versus the value index data, that overwhelmingly over the long haul, you're better off just sticking with growth.
Another question here from Mark, and it has to do with the presidential election. And I seem to recall that you've actually done some work as far as looking at the stock market as a predictor of the future president.
That's right. Going back to World War II, what I have found is that if the market declines from July 31 through October 31, then the incumbent person or party tends to get replaced. So a decline in the market says we're going to get rid of who's in office right now. An advance in the market says, nope, more times than not, and I'm talking 85, 89% of the time, that if the market goes up in that 3-month period, the incumbent person or party is reelected. There have been a couple of times in which it did not work. Back in 1956, the market fell, yet who would have thought that Adlai Stevenson would beat Dwight Eisenhower? I think it had a lot more to do with what was going on around the world. You had Gamal Nasser seize control of the Suez Canal. You also had the Hungarian uprising. You had Eisenhower's heart attack the year before. So I think there were a lot of factors that made that indicator not work very well. Ditto for George Bush the first, Bush 41. I think a lot of that had to do with one party exhaustion, because you had Reagan for 2 terms, Bush for 1 term, and you also had Ross Perot as a third party steal a lot of votes from Bush.
It's very interesting. In terms of a number of questions regarding the bond valuations and bond prices, it seems like we've had bonds have been doing quite well for some time. Is that going to change going forward?
Well, a lot of people were saying to me that, gee, I really don't want to be owning bonds because, prior to this bear market because they're expensive. And I say, yeah, but their behavior still is such that they're the only accessible asset class to average investors that have a negative correlation to equities in a falling stock market environment. And we saw that this time around. Just plot out TLT from February 19th to March 23rd, and you'll see that they were up by double digits while the market itself was down by double digits. So, in terms of attractiveness, well, you're really not going to be getting the yield that I think most investors would like, and hence you had so many people gravitate toward utilities and real estate. But in terms of defensiveness, it's almost like if you're, after this video, go onto YouTube and pull up fainting goats, and you'll see it's a type of goat that when startled, their limbs freeze and they fall over. And that's what investors are like. They gravitate toward defensive sectors. They also gravitate toward treasuries in a very challenging stock market environment.
Charles, do you have any questions for us?
Yeah, I have a couple. One member asked, and this is probably a question that pertains to a lot of our members. They're in retirement and they're concerned about sequential returns risk, primarily questioning what they do about withdrawals in the current environment.
Being more of a market historian than actually, a practicing financial advisor, I don't have that kind of software to really offer. I think one reason, that investors want to take a look at that chart that I had called Using Stock Market History as Virtual Valium is to remind yourself how quickly the market does get back to break even after market declines, especially market declines below 20%. My feeling is, you have to be very careful if you are living on a fixed income and you are planning on living on 4% of your overall asset base over an extended period of time, then yeah, you probably have to tighten your belt. I don't have any kind of scientific numbers to spout out as it relates to that. But gee, Charles, maybe that's something you and I can write in one of the journal articles.
That'd be great. Another question we had was asking about changed behavior and what impact would it be if we do have a change in behavior from people sheltering in place, getting the habit of not going out as much, not traveling as much. Any thoughts on that?
Well, sure. I mean, just think about what you're doing right now. Right now, I'm loving the fact that I still have money in my pocket. I've not been going to the restaurant. So I've actually been saving an awful lot of money. I did see a cartoon where Dennis the Menace was complaining, gee, Mom, do we have to have groceries again? Can't we go to a restaurant? So yeah, you might get tired of that and want a little bit of a change of pace. But I think people are realizing that they're able to save an awful lot of money just by cooking at home. I do think that we're going to see a much greater acceleration in terms of comfortable attire. How many versions of the same sweatpants do you have? And do you really want to start wearing, more stuffy clothing when we go back to a work environment after this is all over? So I think the longer that we end up sheltering in the place, the more comfortable we're going to be feeling with our attire, et cetera. And usually the old adage is that it requires at least 1 month for it to become a habit. So I would tend to say a lot of people realizing that I can get more people to tune into a webinar than I can to get them to come to a hotel to listen to me present. So I see us doing a lot more presenting via Skype, via Zoom, in webinar mode, et cetera, than we do traveling around the country for relatively small gatherings.
Sort of related to that, but in terms of change of behavior, but in the past, when people have been sort of stuck home like this for some period of time, there's been a baby boom 9 months later. Have you seen any kind of historical precedents for this, and what impact might it have on the economy or the stock market?
Yes, well, that is certainly something that people have been talking about, where there could definitely be a baby boom. I mean, usually we have baby booms after blackouts in New York City, et cetera. Baby booms after returning veterans and so forth. So companies, whether they happen to be like Nestle that owns Gerber and a lot of the Beech-Nut baby food, whether you're dealing with Kimberly-Clark in terms of diapers, whether you're dealing with General Foods, et cetera, for baby food, et cetera. So yeah, just think of all of the things that you are either using now if you have young children, or remember what you did use when you had young children, and you could end up seeing a spike. Maybe that's one reason why consumer staples are actually doing relatively well right now, even though the market itself has advanced by nearly 25%.
A number of questions here having to do with the level of government debt that's going on and going to be incurred. Is that going to be impacting, corporation growth or just economic growth down the line?
I think it's got to serve as a drag. I mean, think about the Christmas Carol movie of the early 1950s, Alistair Sim version, when Marley comes in and he's dragging these money boxes with him. He can't really move all that agilely. So I would tend to say that, the companies, individuals, governments are going to have a hard time growing if they have so much debt that they have to drag along with them. The only benefit to a country like the U.S. is we print our own currency. We can pay off our own debt by just, accelerating, the printing presses. Of course, that would lead to an increased inflation that the Fed probably would have no problem with. Might also lose a little bit of confidence in the dollar, which would bring down the value of the U.S. dollar, which I think some exporters would not have a problem with. But it seems as if it's a concern that has been around for quite some time that nobody in Washington seems to be worrying about. And the market itself, I like to say that equity investors are like nighttime drivers who only use their low beams. They're only focusing on what's going to happen in the coming 6 to 12 months. and having a big debt crisis is not something that they see in the next 6 to 12 months.
Say we're getting questions regarding buybacks and dividends. Now obviously companies now, you mentioned focusing earlier on companies have sustained their dividends, but we're seeing a lot of companies now go into cash conservation mode. Any comments about how to navigate that or what impact it might have on the market?
Sure. Well, I think that the first thing to go will be the share buybacks. I mean, what was happening was that in the earlier part of this bull market, because revenues were pretty light, that corporations therefore said, well, I've got to bolster my earnings by reducing the number of shares so that the earnings per share looks even better. Well, now actually with the government saying, well, we're going to give you corporations some money, but we want you to promise not to buy back shares as a result, companies are saying thank you, because they didn't want their shareholders to say, hey, how come you stopped supporting the shares by buying them back? So yes, they're in the cash conservation mode. When it comes to dividends, however, I think that's a bit more challenging. Depends on the company you're dealing with. If you have a company that has paid a dividend, or even a company that's a dividend aristocrat, meaning one has increased their dividends in each of the last 25 years as a minimum, they're not growth companies, they're income companies. And so the last thing that they want to do is disenfranchise their income investors. So a company like Exxon recently said, yes, we're going to be going into cash conservation mode. We are going to go into a CapEx reduction environment, but we are going to maintain our dividend. Johnson & Johnson just the other day raised the dividend, even though that they saw that the revenues had come in a little bit lighter than anticipated. So for investors, I would say a few things you can do. Go on to proshares.com, look up NOBL, which is the S&P 500 Dividend Aristocrats. And in that website, you'll have something called holdings, and it'll show you all 54 companies in the S&P Dividend Aristocrat list. And then take a look at them, look at the debt to equity ratio, look at the payout ratio, and make sure that you have a company that can support this, this dividend in the form of a payout ratio that's less than 75%, et cetera. Take a look at the S&P quality ranking. If it's A-, A+, it has a very good track record of raising earnings on a consistent basis. So, you know, if they're in that dividend aristocrat list, they've been increasing their dividend in each of the last 25 years or more, and I don't think that they want to stop now. But just in case, take a look at the payout ratio to make sure that they do have the cash flow in order to maintain that dividend going forward.
In terms of, do you have any outlook as far as gold or inflation? Is that something you study normally?
Yes. Well, I mean, gold really is much more of a technical trend right now. Gold is are nervous about the market, so that's one reason. A lot of stimulus into the economy so that when we do turn around, expectations are we could see a pickup in inflation. And with the yield on the 10-year note being below 1%, where's the competition? Gold tends to, since it does not pay a dividend and you traditionally have to store that gold, it ends up being expensive to hold in a rising interest rate environment. But because of rising uncertainty and very low interest rates, I think investors are saying, you know what, I want to be gravitating toward gold right now.
Sam, I'll ask you real quick about, you ever brought it up, your rule about buying on 7% drops. I've seen you write about it before. Could you elaborate that and explain it to our members?
Sure. Well, it goes back to that chart where I was talking about using stock market history as virtual Valium, that we have these pullbacks, which are 5 to 10% declines. Well, the average decline is 7% in a pullback. In a correction, a 10 to 20% decline, the average decline is 14%. And in bear markets, the median decline is 28%. So if you remember the old book, The 7% Solution, even though it was referring to Sherlock Holmes, you could sort of use this to refer to, well, when might I want to start adding to my positions in market setbacks? Now, of course, if you're dealing with a 33% bear market, adding money every 7% of the way down, you might be thinking, gee, I would have been better off if I had found a rule of 30%, meaning I'll only put money in once it's fallen 30%. But more times than not, if you are dealing with declines in the market, you are dealing with some sort of a multiple of 7. And if you're simply looking for, let's say, an opportunity to either rebalance or to add to equity positions, more time than not, you are doing yourself a favor by adding to your holdings at every 7% decline threshold.
And I just want to remind our audience that we're taking notes. Any kind of websites that are mentioned tonight, be it the Dividend Aristocrats website, the access as far as information regarding the ETF that Sam was talking about before, we'll have show notes available to accompany the slides, so people will be able to access all of these resources afterwards. I know, Sam, we've kept you even longer than our original schedule time. Do you mind taking 2 more questions before we sign off for the night?
I'm happy to do so. I didn't even know it was that long, so I'm enjoying myself.
Well, thank you. In terms of your best to worst scenario, I think you were talking primarily in the domestic market. Does that hold true in foreign stocks as well? Have you done any work along that line?
Good question. No, I have not. But all of the analysis that I have done, whether it relates to let your winners ride or even seasonality, it holds true whether you're dealing with the developed international or emerging markets, that from a seasonal perspective, they do horribly May through October, but do very well November through December. So my guess, without having done the analysis, is that the worst to first would also work overseas as well.
And Charles, I'll let you close out the evening with the last question.
Yeah, someone's asking about if this pandemic lasts longer than expected, and we have a series of either shelter-in-place orders, or we see the pandemic kind of drop and then come back, what effect that might have on the economy and on the markets.
Well, I just read an article today about the Spanish flu of 1918 through 1920, and that's exactly what happened to them. You had the first case of the flu really take place in the early part of 1918. And then as the warmer summer months pretty much dried up the virus, people went back to normal living, only to have it come back with a vengeance in the fall and the winter of 1918, 1919, and have it be worse than what it was in the early part of 1918. Interesting is that in that 2-year period, 1918, 1919, we had 3 corrections, but we did not have a bear market. And so I find that sort of interesting. But here in the US, maybe what that means is we end up falling even below the March 23rd low. If we don't get back to a new, we were above 20% threshold on the S&P 500 recently. Somebody asked me, oh, does that mean we're in a new bull market? And my response is yes, so long as we stay above that 20% level for the next 6 months. So from my perspective, and nothing is written in stone, meaning there's no FASB or whatever that decides what is a bear market and when does it stay a bull market. The way I measure things is it has to be a 20% advance off of the prior low, and it has to remain above that low for 6 months. Otherwise, just like we saw back in 2008, we would have had 2 bull markets and 2 bear markets in that 4-month time frame. We also had 20+% advances in the mega meltdown of 2000 to 2002 and in the 73, 74 bear market. So that's why I say that we need to be above the March 23rd low for 6 months for it to be deemed a bull market, in my opinion. So if we don't get back to a new, if we fall back lower prior to that 6-month time frame, then no, this was one long bear market, that ended up just having a relief rally that started on March 23rd, but the bear itself did not conclude until much later. I hope that was understandable.
Oh, very much so. I'd actually, if you don't mind, I have one more question for you.
Sure.
And it might require you to go back a little bit in time. There's a rumor, I know we're here in Chicago, and we were searching for a kicker last year tremendously. There's a rumor that that they asked you to come out and try out for the Bears as far as being a field kicker.
Well, thank you. I played Division III football for Muhlenberg College, which is in Allentown, Pennsylvania, and I was the last of the straight-on place kickers. And I did have the opportunity. I went 29 for 29 my senior year, and I had a scout from the Rams come and take a look at me. And he said, you know, just by how he held the ball and when I kicked it and came through, he could decide whether I had the power and so forth. And he concluded, he said, Sam, you have good accuracy, but you don't have the power we're looking for. Plus, this was back in the 1970s. And as you recall, they were moving over towards soccer style kickers. So basically the guy said, thanks, but no thanks. But I kept all those rejection letters.
Well, Sam, I think the Rams' loss was our gain, because we've gained a tremendous market historian, someone who's really able to take a lot of very technical concepts, explain them in a way that I think, you know, all of our members who are individual investors can understand and take action on. So, you know, again, I thank you so much for coming to our presentation tonight. Thanks for wonderful information, and I look forward to you know, meeting you again in the future in person, when we can actually toast to the ability to actually meet face to face.
Well, thank you, John. Thank you, Charles. I look forward to it, and let's keep our fingers crossed for Las Vegas.
Very much so. And well, that concludes our presentation tonight. And if you go to our AAI.com and you go to the community section, we have a series of upcoming webinars as well. People who attended this webinar will be able to download the videos and the handouts and everything. And next week, we're going to have Derek Hangeman out. And he's going to be talking about dividend stocks. In fact, he's going to be talking about the dividend aristocrats as well. So please sign up for that. And I think we also have Jay Clayton coming in. He'll be doing a town hall with members on Monday, April 27th at 1 p.m. And Wayne Thorpe is also scheduled to do a presentation on May 6th. So thank you very much. Everyone have a wonderful evening, and look forward to seeing you again next week. Thank you.